Hey everybody, what's going on? I'm Fabian Calvo, founder and president of the Node House and creator of the Resourceful Real Estate Academy. Here with another installment of the Node House newsletter. And in this installment, we're going to be covering really what I think is one of the most important, critical pieces of information any real estate investor should know in this particular market. And like I say many times, it's not just at the tactical level what a real estate investor does to find deals or to put together deals, to execute resourceful deals. It's also what's going on with the Federal Reserve, what's going on with the financial markets that influence what's happening in the asset class that is real estate. And so that, I think, is absolutely critical. And it's a point really that I didn't really touch on too much in my beginning years of investing in real estate. I definitely paid the price and learned a great deal from it. So you might have experienced the same thing, or you might just already have that understanding, which if you do, that's wonderful. But I have to say that in this video, I promise, this is probably one of the most relevant points to any investor, any asset class right now, specifically real estate. I mean, I know people that have paid literally thousands of dollars simply to go to a big investment conference and have this information told to them, or it's delivered and presented in like a 3-day conference where they're breaking it down. I'm going to try to break that down in like 5 minutes, but we'll see if I'm successful in doing it. I guess you'll be the judge. But first, it kind of touches on this today, which was on the cover of the Wall Street Journal. We had big banks settle mortgage hangover. And, any resourceful real estate investor, I think one of the things that you're always doing is you're trying to source deals, find quality investments. And a great place to find those investments is financial institutions of all kinds, hedge funds, whatever it may be. You'll find many times they're looking for people in the local marketplace that they can sell their assets to instead of just selling those loans or those REOs or those bank-owned properties, whatever they are, to just other hedge funds, because they're pricing in that out of the market risk. They don't know the market. They don't know what things are selling for in a particular area. So they're not going to pay more money, whereas a local investor will pay that. Will pay more money for that asset because they know, hey, I can buy this property at this because the home a couple streets down sold for X price, or I really know the fundamentals of that neighborhood. It's getting stronger, or perhaps that neighborhood's getting worse and I want to stay away from it. But whatever it is, typically local investors know much more about that market than the banks, or where these loans or assets, what balance sheet they're on, anywhere, whether it's banks, hedge funds, whatever. But here's the important point that I think is critical. It's this concept of the FDIC loss share agreement, which I think many people may have heard about. They may not really understand, though, how it impacts the big banks specifically. Every Friday, the FDIC goes and shuts down banks that are on the FDIC troubled bank list. Last time I checked, there was over 800 banks on that list. Many more that should be on that list but aren't on that list because it's very political, right? And you have a lot of clout. The likelihood is your bank won't be on that list. But the point is that every Friday, and some Fridays, are skipped, right? So it's not every single Friday a bank is shut down, but when they do shut them down, it typically takes place on a Friday afternoon. They send in the FDIC regulators, and basically the bank's shut down. The assets of that bank are then, in essence, transferred over to the big bank, right? That takes all those loans over, and they take them over and they buy those loans. And in buying them, the government insures the loans and says, look, we're going to insure any risk that you take on. For example, let's say you had Countrywide, who had a huge portfolio of subprime loans. It was sold to Bank of America for, $5 billion. The liabilities were significant. Estimates were $30 billion in liabilities for all the loans, both financial, legal, that were part of that purchase. Well, the government said, look, Bank of America, we're going to insure you against those losses. And the way the insurance policy works with the FDIC loss share agreement is that it's 80% of the original loan value. I mean, you could look this up yourself. Google FDIC loss share agreement, and you'll have PDF files that come up that are actually the specific loan agreement or that loss share agreement. And they're in that general terms, 75, sometimes low 80s of the original loan amount. So how does that work? Well, let's say it was Countrywide and they did a $200,000 loan to, Bob Jones. And Bob Jones defaulted on that loan. And somewhere in between, a new bank came and bought the Countrywide loan, but they didn't pay $200,000 for that loan. They paid, let's say, $50,000 for that loan. So now the new bank owns Bob Jones's loan that Bob Jones owes $200,000 on. They own it for $50,000. Now, Bob Jones can't make his payments. He wants to sell his home. Remember, a good indication of default is no equity in the home or very low equity. So if the homeowner doesn't have any equity or very low equity, chances are he's not going to stick around and keep making payments unless there's some other reason, compelling reason for him to do so or her to do so. So the new bank tells Bob Jones, fine, you don't want the home, you want to get out of it. That's why if you've ever dealt with loss mitigations, one of the first questions they ask you is, what are your intentions of this property? They want to know, do you want to stay? Do you want to go? What do you want to do? So Bob Jones says, I want to sell. He puts his home on the market. Sally Realtor sells the home for $100,000. The bank says, fine, we'll take the $100,000 and we will release you of your deficiency. You owed $200. The sale netted $100. So that $100,000 that you supposedly still owe, we'll let you off the hook for that. So the bank, in this case, just made $50,000, right? They paid $50,000 for the loan. The short sale process netted them $100. They made 50. But it doesn't just end there. Here's where the loss share agreement comes into play. Since the federal government is insuring up to 80% of the original value, they're now going to pay the bank $160,000 insurance money. Now, they're not going to pay $160,000, but they are going to pay them another $60,000 on top of the $100,000 the bank already made to satisfy the loan as part of the FDIC loss share agreement. So if you understand, the bank that bought Bob Jones's loan made $50K on just buying it at $50, selling it at $100. But because of the FDIC loss share agreement, they just made another $60,000 on top of taxpayer money. That's why when I see this article on the cover of the Wall Street Journal, big banks settle mortgage hangover, well, of course they're going to settle the mortgage hangover. And they're going to, they're talking about this big payment of $20 billion. Where is the money coming from? The money's coming from what is probably one of the largest backdoor bailouts that has ever taken place in history. Remember, in addition to the $800 billion plus TARP bailout that was supposedly to go to the banks to buy these mortgages and then work out loan modifications. Within a couple days of getting the money, the bank said, well, you know what, we're not going to do that. Instead, we're going to or the Treasury said, we're not going to do that. Instead, we're just going to lend the money directly to the big banks, let them do what they want to do with the money. And then we heard the big thing that they paid the money back. Well, they paid the money back using tactics like the FDIC loss share agreement, using taxpayer money and monetizing these transactions, these defaulted loan transactions, monetizing them in a way using the leverage of the FDIC loss share agreement to pay back these loans. I would also make the argument that the money that they're using, this $20 billion, is money from that FDIC loss share agreement, that money that they're making, again, on a daily basis. B of A, all the big mega banks are closing loss share or closing short sale agreements, or they're selling foreclosure deals where they have this FDIC loss share agreement kick into play, which is making them billions upon billions of dollars. Now, just the world we live in. I don't like it. You probably don't like it either. But again, it's just the world we live in. And as a real estate investor, what does that mean to us? Well, it means that this gives you a lot of leverage in dealing with banks that may be on the FDIC troubled list. I mean, if you're dealing with a bank that's on that FDIC troubled list, hey, they have assets they have to sell or they're going to get shut down. And someone's going to have to take a haircut. So if you know that going in, you're a much better negotiator. You're a much better investor just because you know the outlying factors that influence the overall transaction, right? What are the motivations behind the seller, the buyer, all the parties involved? That's a very important piece of information to know. The second critical point of knowing this is when you deal with banks that you might deal directly with the loss mitigation officer or the special assets officer. A lot of times I found, in fact, most of the time, the people that work at the banks are unaware of the loss share agreement themselves. They don't even know this because it's really not at that level. It's not like the FDIC is handing them the check and then they go give it to their manager. They don't see that money, so they really don't know. So it also allows you to position yourself as, listen, you're an expert in this. You're providing service, and your service is you're going to help this bank deleverage their troubled assets and sell them, whether to your best buyers that you find or to yourself, and then you go and monetize that deal however you want to monetize it. So there you go. I can tell you that this piece of information is a piece of information that I know that people have paid a lot of money just to have people from like the Federal Reserve come down and explain how all this works to a group of banking, people, that banking executives or whoever it may be, to understand how it works. So I hope it's been of service. I hope that it's helped you out. If you enjoy it, please share it. And remember, if you're new to these newsletters, or if you're just getting this because someone shared it with you, go to thenothouse.us, you subscribe, you get some really great free content that we send out that's just informative videos that we implement every single day at the Note House in the tens of millions of dollars of deals that we do in buying distressed notes, buying REOs, whatever it may be. So again, I hope this is of service. I'm Fabian Calvo. Have a wonderful day. Thank you for watching. I'm out.